Is a recession looming for America? So in investing circles, the talk has been so focused on inflation that the risk of a recession has been somewhat overlooked. Now in this video, we're going to hear Chamath Palihapitiya's thoughts along with his co-hosts on the All In podcast. In this, they break down their beliefs today on inflation and the potential of an added recession on top. Let's get straight into our first clip.
Ask you, Chamath, does this mean on an investment thesis, you might see a massive spike in carbon-based fuel systems and these sovereign wealth funds, and then a dramatic drop-off?
No.
Okay. What do you predict will happen?
Nobody will support anybody investing in pulling more oil out of the ground. They'll support trying to get more from what we have. But I don't know if you guys saw, but there's no support for this. Whether you're an investor and you go activist on some of these oil companies, I think Biden had a big setback because, he had cleared a whole, millions of acres of offshore land for some kind of energy extraction that was then just reversed by the courts. No, but nobody has support for this stuff.
But but what you're saying is exactly right, and it's exactly the reason oil prices are climbing. I just sent you guys a link to what's going on today.
They're climbing for the wrong reason. So look, let's just be realistic here. We have a cartel. It's called OPEC. And what they do is they decide output, and we have some checks and balances to OPEC, namely Russia and a few other actors, who will try to then regulate supply and demand so that there's mutually assured destruction. The net result of all of that right now is that we do have some constrained supply for the amount that we need to get back to the level of production we had pre-pandemic. So we are going to have some sustained energy prices. But you saw something really important this past week. Everybody was waiting for this big CPI print, right? The Consumer Price Index print. Everybody thought it was going to be a bad number. It was a pretty bad number, but the markets were pretty responsive to it. And then it's been pretty responsive the rest of the week, despite a whole bunch of stuff. I don't know if you guys saw it, but yesterday there was this crazy article where, one of the Fed governors was like, we should raise by 100 basis points by July. And, we should do eight raises. And the markets were like, what are you talking about? And why is that? Because now people have started to look, I've mentioned this before. When you go into a rate cycle, we're kind of past worrying about how many. We kind of look to the end and decide what we want to believe about the future. And one of the most interesting things is the rate of change of this inflation was actually lower month over month. And so if you think about it that way, we had a bad CPI print, but it's actually not going up as much. And in fact, it's starting to trail off. And a lot of economists now forecast basically this inflation peaking or already having peaked over the last few weeks. Consumer sentiment is not so good. A lot of us are now shifting our consumption away from goods to more services. We're stopping, the hoarding of the toilet papers of the world, if you will. Sachs, what do you think about inflation?
Okay, there was a really interesting chart on inflation that actually Zero Hedge tweeted, and I threw it up in the notes here, where they said real hourly earnings are negative 1.7%. It's the 10th month in a row where U.S. incomes aren't keeping up with inflation. So the problem here is that, people's incomes have increased with inflation, but not as much as the inflation rate. So the net effect of it is that people are feeling worse off. When they go to the grocery store to buy groceries or whatever they need, they don't feel as rich. That's the fundamental problem here. And I think there's a lot of people out there who think that there's a free lunch, that if we printed $2 trillion worth of stimmy checks, this was that $2 trillion bill last year that they shoveled through. I think the idea was we're going to print as much money as we can before the election, and it's going to help us in the midterms. Actually, as it turns out, it boosted inflation so much that people are feeling worse off, even though their wages went up slightly, because on a net basis, their earnings are down. So I just think it's a good reminder that you can't just print wealth. You can't print your way to prosperity.
No free lunches?
There's no free lunches.
Yeah.
Or we're going to create addiction to universal income or universal subsidy. That's the alternative, is people are going to basically try and vote to make some programs that were initially meant to be temporary more permanent. in order to keep up the lifestyle that they've become accustomed to.
Just to build on Sachs's point, the University of Michigan Consumer Sentiment was released, I think it was this morning, and it shows exactly what he's saying, which is that, consumers' propensity and confidence in the economy has been falling off a cliff. The month-over-month change was it was down 8.2%. The year-over-year change is down almost 20%. Current economic conditions was down 20%, and then index of consumer expectations down 19%. So to Sachs's point,
people are scared.
Yeah, well, we've been talking on the show for the last, I'd say, a couple of months about balancing the risk of recession versus the risk of inflation. Inflation, I think, has gotten slightly worse. The print went from, the last print was like 7.1%, now it's 7.5%. So to Chamath's point earlier, it's getting worse, but the rate of how fast it's getting worse is slowing.
Could be peaking.
But the risk of recession, I think, is increasing because what's keeping this economy going is the consumer. And if the consumer sentiment now all of a sudden is tanking and people feel poor because of inflation, I just, now the risks are starting to become more balanced.
As sentiment goes down, this is where governors play a critical role, because if they don't open up these economies, we can't actually have a consumer-led consumption rebound of the economy because there aren't any services to buy because you can't actually be around anybody. So if the economy remains effectively closed and people are done buying, tubs of margarine and toilet paper because, Armageddon isn't coming as we were worried it would, what are we supposed to be doing? So this is how these things interplay. So we have to get these, again, going back to where we started, we have to get this economy open, and we have to just get back to some sense of normalcy, and the consumer will lead us out. But I think, Sachs, you're right. On the margin, I think the risk is towards a recession because people don't see this. Thomas Sowell, who's a well-known Stanford, I think he's a senior fellow at Hoover. He has this comment, which is effectively taxes are bad for the rich and the poor, but inflation is bad just for the poor. And the reason he says that is because, if you're wealthy, you can transition to assets that are sort of inflation adjusted or inflation protected, right? You can consume assets or you can purchase assets to protect yourself. But inflation is an exceptionally regressive means of the government taking compensation away from you, current compensation, and it disproportionately affects working class, ordinary people. And so if you have real wages that are negative, inflation that's high, that's confiscatory, right? You are meaningfully less well off than you were before. And, the wealthy folks have a way to hedge, but normal, ordinary working class people do not. And on the margin, then, if they then do not go out and spend, the problem will be some sort of recessionary effect.
Okay, so it's no secret that the inflation figures have been climbing for several months. However, as noted in the video, the rate at which the rise has been occurring has begun to drop off. In other words, some forecasters are predicting that inflation is beginning to peak and then may come back down. Having said that though, one thing we know is that market predictions are about as useful as a chocolate teapot. That's why I want to share 3 investments that you can look into to protect your money in case inflation does continue to rise. So the first idea comes from the legendary investor Warren Buffett. In a letter to shareholders, Buffett once said that favored businesses in times of inflation must have 2 characteristics. 1, an ability to increase prices rather easily, even when product demand is flat and capacity is not fully utilized, without fear of significant loss of either market share or unit volume. And number 2, an ability to accommodate large dollar volume increases in business, often produced more by inflation than by real growth, and only minor additional investment of capital. So, what does Buffett mean here? Well, in this first point, he discusses businesses who can raise their prices to pass the cost onto the customer. This typically is only possible with companies that have significant moats. So take Apple, for example. Whether you like them or not, they have a fan base of loyal customers who will continue to buy their products even in the face of rising prices. As a result, they can continue to charge higher prices and raise those prices more easily than a less differentiated company. And in Buffett's second point, he likes to invest in growing, scalable businesses. So in this example, think of companies who are pioneering new markets and have high growth potential. Even if inflation fears are dragging their valuations down, they can counteract this negative via the high potential they have for expansion. The second investment is gold. This chart shows the S&P 500 performance year to date. In other words, the American stock market. This chart, however, shows the Spider Gold Trust ETF performance year to date. This is an ETF which allows you to invest in gold without having to physically store the gold yourself. As we can see, gold has performed pretty well this year so far, and that comes from the fact that gold is generally seen as a storehold of wealth. And of course, anything which stores wealth is likely to perform well in times where wealth is being eroded due to inflation. Now, here's an interesting one for you. Investing in gold would have produced the same result as that produced by Berkshire Hathaway between 1964 and 1979. This is a direct consequence of the high inflation that was persistent during that time. Now, as a guide, Ray Dalio recommends investing 7.5% of a well-diversified portfolio into gold at any one time. The third investment is a controversial one, but hear me out. It's Bitcoin and cryptocurrency in general. Now, a lot of people in crypto describe Bitcoin as a hedge against inflation. Personally, I don't agree. Maybe someday, but not today. But what you have to understand here is that the Bitcoin story is one of adoption. So let's say inflation fears, rising interest rates are weighing down on Bitcoin's price. This provides the negative downwards force. On the opposing side, pushing the price up is the rising long-term adoption. This force pushing up is extremely powerful in the long term and is entirely uncorrelated to everything else in the world. Now, don't get me wrong, in short-term dramatic moments like we've experienced this year, Bitcoin and crypto will absolutely be correlated in the short term to other investments. When we have a liquidity crisis, literally every single investment out there is correlated. Of course, Bitcoin and crypto will be correlated in these times too. Literally everything is. However, in the long term, because of this story of adoption driving up the price, Bitcoin's long-term correlation will remain low with other investments. And as a long-term investor, it's only the long-term correlation that I'm personally interested in. Now, for me, the best investment plan has two things. Number one, it provides you with sufficient diversification and liquidity that you can survive and thrive in any market situation. And number two, you stick to your plan. It's all well and good having a plan, but if you don't stick to it, what was the point in the first place? So today for me, my portfolio looks something like this. I have around 7% of my portfolio in gold, 20% in crypto, and the remaining 73% in stocks. The stocks are mostly passive index investments across the US, the UK, and emerging markets. And of course, some of my stock positions are in ARK and Scottish Mortgage Investment Trust, both of which focus on innovation investments. So that is my plan on how to invest in the coming months and years. Now I'm keen to hear your thoughts. What does your plan look like? Are you sticking to your plan or have you changed it? Be honest, let me know your thoughts in the comments below. Thank you for watching and I will see you again very soon.